Do you ever feel your favorite stock is expensive or cheap? But how do you really know? Today, let's understand with one simple formula in just 4 minutes how to identify whether a stock is overvalued or undervalued. We'll take an example using two popular Indian banks, HDFC Bank and Bandhan Bank. Let's go. Step 1. P/E ratio. The first step is understanding the P/E ratio, which means price divided by earnings per share. It tells you how much investors are willing to pay for every 1 rupee of earnings. Generally, a low P/E ratio means a stock looks cheap, but not always. Because sometimes, a low P/E ratio exists due to low growth or high risk. Let's check it live on screener.in. HDFC Bank has a P/E ratio of 20, while Bandhan Bank's P/E ratio is just 12. So does that mean Bandhan Bank is cheaper? Not necessarily. A low P/E ratio doesn't always mean undervalued. You also need to check the company's growth. Step 2. P/E-G ratio. That's where the P/E-G ratio comes in, a more accurate way to judge a company's real value. The formula is simple. PEG ratio equals P/E divided by earnings growth rate. If PEG less than 1, the stock is undervalued. If PEG equals 1, fair value. If PEG greater than 1, overvalued. In short, valuation makes sense only when growth is factored in. Let's take an example. HDFC Bank, P/E ratio is 20 and growth is around 20%. PEG equals 1, fair value. Bandhan Bank, P/E ratio is 12 but growth is just 5%. PEG equals 2.4, actually overvalued. So you see, even if a stock looks cheap with a low P/E ratio, if the growth is weak, it can still be overvalued. Step 3. P/B ratio. Now, the third and most important step, the P/B ratio, which means price to book value. This is especially useful for banks and financial companies. The formula is P/B equals price divided by book value per share. Generally, P/B ratio less than 1 means undervalued, and P/B ratio greater than 3 means expensive. HDFC Bank has a P/B ratio of 2.8, which is reasonable. Bandhan Bank has a P/B ratio of 1.1, looks cheap, right? But that could be a case of quality discount, which means higher risk, lower growth. Understanding quality discount, let's understand this important point. Bandhan Bank's P/B ratio is just 1.1, while HDFC Bank's is 2.8. So Bandhan looks cheaper, right? But it's cheap for a reason. In the market, we call this a quality discount. It means the stock looks cheap, but that's because the market is not confident about its quality, stability, or growth. Think of it like phones. An iPhone is expensive but people buy it for trust and quality. A local phone is cheap, but has no guarantee. That's a discount for low quality. Similarly, Bandhan Bank's low P/B ratio exists because the market is pricing in risks, microfinance exposure, NPAs, and slower growth. That's why it trades at a quality discount. So remember, a low P/B ratio doesn't always mean undervalued. Sometimes, it means the market doesn't fully trust the company yet. Let's recap quickly. P/E ratio for HDFC is 20, and for Bandhan is 12, but low P/E ratio does not always means undervalued. PEG ratio for HDFC is 1 and for Bandhan it is 2.4, which shows that Bandhan is actually overvalued. P/B ratio for HDFC is 2.8 and Bandhan is 1.1, which is a quality discount, risk priced in. So overall, HDFC Bank is fairly valued, while Bandhan Bank's low valuation also comes with higher risk. Now you know how to check if a stock is really undervalued or not. So next time someone says, "This stock looks cheap," you say, "Did you check the PEG and P/B ratios too?" If you found this video helpful, hit the like button, subscribe to the channel, and comment below, which stock are you going to check today? And before you go, I've added the screener.in link in the comment section, where you can check all these ratios for free.